Welcome to Thoughts on the Market. I'm Graham Secker, head of Morgan Stanley's European Equity Strategy team. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the rising cost of capital and its implications for European equities. It's Tuesday, June the 14th at 2 p.m. in London. As we have discussed previously, we believe that we have witnessed a paradigm shift in the macro and market backdrops over the past couple of years, swapping the secular stagnation of the last decade with a new cycle where nominal growth is both higher and more volatile. An alternative way to think about this is that the policy dynamic has shifted from an environment of loose monetary and tight fiscal policy over the last 2 decades to one of looser fiscal policy but tighter monetary policy today. If this characterization proves to be true over the coming years, the longer-term consequences for investors will be profound. While this may sound somewhat grandiose, it is worth noting that global interest rates fell to a record low in this last cycle. From such an unprecedented low, even a moderate increase in borrowing costs may feel significant, and we note that we have just witnessed the largest 2-year increase in 10-year US Treasury yields since the early 1980s. The fact that we are starting a new and relatively fast rate hiking cycle at the same time as central banks are shifting from quantitative easing to quantitative tightening further magnifies the risk for spread products such as credit or peripheral debt, both of which have underperformed materially over the last couple of months. At this stage, we think it is this dynamic that is arguably weighing most on equity markets rather than the economic impact of higher borrowing costs. When thinking through the investment implications for European equity markets of this rise in the cost of capital, we make 3 points in ascending order of impact. First, the consequences of higher borrowing costs are likely to produce a relatively small hit to corporate profits. While we are concerned about a significant decline in corporate margins over the coming quarters, this is predominantly due to higher raw material prices and rising labour costs. In contrast, even a doubling of the effective interest rate on corporate debt should only take around 2.5% off of total European earnings. Second, we see a more significant impact from higher capital costs on equity valuations, as price-to-earnings ratios have exhibited a close negative correlation to both central bank policy rates and credit spreads over time. Hence, while European equity valuations are now beginning to look reasonably attractive after their decline this year, we think risks remain skewed to the downside over the summer, given a tricky backdrop of slowing growth, high and sticky inflation, and hawkish central banks. Finally, the most significant impact from higher borrowing costs will, as ever, be felt by those entities that are most levered or require access to fresh funding. At this stage, we do not expect the ongoing increase in funding costs to generate a broader systemic shock across markets. However, we do see ample scope for idiosyncratic issues to emerge in the months ahead. Logically, identifying these issues in advance primarily requires due diligence at the stock level. However, from a top-down perspective, the European sectors that are most correlated to credit spreads and/or have the weakest balance sheets include autos, banks, consumer services, food retailing, insurance, telecoms, and utilities. Ultimately, the volatility within asset markets that will accompany the largest upward shift in the cost of capital in over 30 years will create lots of opportunities for investors. However, for now, we recommend patience and await a better entry point later in the year. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.